The broadcast is now starting. All attendees are in listen-only mode.
Okay, mic check. Mic check. We'll be starting soon. Mic check 1, 2. We shall be starting soon. Okay, hold on please.
Good morning, everyone. Welcome, welcome. For this week, we have more stuff than we had in the past. That's good news. So a little bit of safe harbor. And first theme that we're going to talk about today is Dogs of the Dow. So for those of you who are not familiar with Dogs of the Dow, it's a nice little strategy that was brought up, I think it was the early 90s, 1991, through a book. And it became quite popular in U.S. investing because it's simple, very, very simple. The idea behind it is that once per year, you look at the Dow Jones Industrial Average. You pick out the highest yielding dividend stocks within that index, the top 10. You buy those in equal weightings, and then you rebalance every year. So, every 365 days you would rebalance. It's nice because it's obviously very simple, but it also works. And so by working, I mean more over the long term. Okay? What it does is it tends to pick out of favor cyclicals, because the Dow Jones Industrial Average tends to have its fair share of cyclicals in it. It has superior dividend income because you are picking high yield stocks. Unfortunately, it does lag during sustained bull markets, and that's because it tends to have these more defensive stocks in it. But it is resistant to drawdowns. This is important for your typical retail investor, because everyone loves to tell the story about how they made a lot of money on the upside, but they really don't tell you about how you really do outperform the market over the long term, which is not having big drawdowns. And so by having this type of profile, it avoids or is resistant to these large drawdowns. Also, the key thesis behind this is because it is a benchmark index, it already includes some blue chip stocks, or it's only blue chip stocks that's in it. So it's already been pre-screened, so you won't have those giant blow-ups. Now the question is, does it work in Singapore? And according to our research, it does work. The caveat there is that it has a short history that we looked over. So since the end of 2007 until now, you have very similar dynamics, which is you have pretty good cyclical bounce after essentially a crisis, and then it does lag during bull markets, which is over the last 2 years it has lagged behind the STI, but it is resistant to drawdowns. Now the key takeaways again is don't forget to pick up those unloved stocks. So stocks that you might want to consider looking at, not necessarily buying right now, but looking at because they might have a cyclical bounce, are stocks that might make you cringe right now, but they're definitely worth looking at. Companies like Noble Group or the two rig builders, Keppel Corp and Semcorp Industries. The second thing is defensive stocks are okay to own during a bull market because unless you're really great and have proven that you're great at top ticking the market, they more than pay for themselves when there is a turn in the market. Now there are ways to play this. If you want to play the U.S. market, you can do that through 3 ETFs, going from DoD, starting off with as the most adherent to the theory of the Dogs of the Dow, and then moving down the chain, they're less adherent to it, but they have lower costs as you move down to SDOG, is actually the ticker, not SDOD, but SDOG, and then HDV. And then if you want to, you can actually replicate it yourself. At the end of last year, the 10 highest ones are there listed there, and if you owned GE on Friday, you would have made a pretty good amount of money simply because of GE's restructuring there. And then AT&T was included at the end of last year, although it's been replaced since then. but it would be something that would be in the Dogs of the Dow portfolio. And then if you were to do it in Singapore, you would essentially have Noble, SemCorp, Keppel Corp, A-REIT, Hutchport, CMT, SIA Engineering, ST Engineering, SPH, and StarHub. Now moving on to a second theme, some of the themes that we're looking forward to in Q2. I think it's important to note that some of the trends that have really worked in the past, and they've worked for a long time, they've worked over the last 2 years, and that everyone's been saying for quite a long time. Now we're saying it's the time to stop really saying those things over and over again. The key one being divergent monetary policy, which has led to a big change in currencies. That is the strong U.S. dollar. So there's a lot of people out there, other brokers, who are pushing that theme. We think that theme is more or less dead. Weak commodities, and India and China are really, really strong. So we're looking forward to some new themes into Q2. Number one, we're looking for the euro to decrease or decelerate its pace of depreciation. Second of all, we're looking for oil prices to be finding a bottom right about now, and then start appreciating starting in May. We put out a report by Ben that talks about reasons behind why we're more bullish on oil. Thirdly, we're looking at a selective bottom for commodities, not in the hards, more in the softs. At least for the Singapore market, best way to play that is the palm oil sector, as we look for soybean prices to start rising from here, which will then pull up the palm oil side. Fourthly, we're looking at some themes here, which is the theme is pretenders or reformers. And so we've had 5 key markets that have done quite well, or at least there's been some hints of promise behind them. So those are India with Modi, Indonesia with Chikawi, Japan with Abe, China, and then Thailand with 2 relatively new regimes there to really prove whether or not they can actually push through reforms. Today you saw that there was a new report on Thailand where we are declaring that they are pretenders. And so we'll talk a little bit more about that later. Fifthly, you're looking at Hong Kong. We're looking for Hong Kong to catch up from the rest of the mainland. Hong Kong market, that is the Hang Seng, very much is China. So A shares are something that looks quite attractive right now. You're looking at the premium of A shares over the H shares being one of the highest in its history. And then lastly, U.S. consumer, which has been one of the key reasons why U.S. market has kind of stalled right here because of the weak numbers. We are looking forward to them actually doing better in Q2. In the week ahead, what we're looking forward to is earnings season. For Singapore, you're starting to see M1 Soil Build, Keppel Group being the key ones, SPH being the key ones reporting this year, and then the U.S., which is much more earnings related than economics, although there's some interesting economic data coming out of the U.S., pretty broad-based, probably the most important one being Beige Book on Wednesday to see what the Fed is going to be saying as far as the economy there and the pace of their rate hikes. Then from that, I'll hand it off to Sam with his view on U.S. markets.
Hi, morning everyone. This is Sam, and I'll walk you through on the U.S. economy. Okay, first thing first, we still maintain overweight on the U.S. economy. In this presentation is more of like a thematic on U.S. rather than a general economic one. So it's a thematic focusing more on the consumer spending. Why consumer spending? Because consumer spending contributes to more than 70% of U.S. GDP. And the focal point of U.S. economic recovery has been the revival of consumption spending ever since 2008 to 2009, and this is something what Fed closely looks at as well. Economic data shows that the consumption has remained subdued for a while, but the top right-hand chart shows you that it has been flat, but things have started to change. The chart on the personal consumption expenditure shows that things have started to change since, I would say, earlier this year. Okay, so what drives consumption? What drives the consumer spending? So 4 things I'll be focusing upon four things. Number one, aggregate income. Aggregate income includes wages and salaries. Wages are on a downward trend so far, while salaries are on the upward trend. But if you take a look on a left bottom right-hand side chart, the real disposable income, you'll see it's increasing. It's increasing since early 2014. Which is a good sign. That means people have more income, more money left to spend. Number two driver, employment. Employment rate has been around 5.5% for the last few months, and this is somewhat nearer to their pre-recession average. But the most important thing here is that the underemployment, or those marginally employed and part-timers, have been reduced as well. You can see that the gap between the U6 stats with the compared to the unemployment is shrinking. So the gap is decreasing, which is a sign of normalization that shows that the employment is moving towards what it was before the recession. Another positive sign. Consumer confidence, third thing in the household data. Okay, consumer confidence. Okay, the chart is on the next side. Okay, next page. So, consumer confidence, you can see, has been going up since 2009, smoothly rising. So, usually, consumer confidence shows that people are happy. They are happy about. They remain positive about the outlook of U.S. and that helps them to spend more. Household debt consists of two important things. One, revolving credit, which includes credit cards and student loans, and then the non-revolving one, which includes mortgage debt. And a chart, the bottom right-hand side, shows two different trends. One, the mortgage debt is still on a decreasing trend, confirming there's still some deleveraging going on the household side. And on the other hand, the consumer debt has already rebounded. Since March 2003, which is a good sign, and which shows that the credit availability is there. It's easier to get credit now, especially for the lower end households. So what we expect that low energy prices and increasing personal income via improving employment will spur more consumer spending. Strong growth in aggregate personal income and easy credit, like I just mentioned now, will help not only the consumer confidence, but in return, and the most important thing, it will push household spending. So how do we take these changes in the consumer side? I mean, how are we going to use it? So we believe that, okay, due to all these trends, consumer discretionary, which includes recreational goods, airlines, and consumer durables, including autos and automobile and furniture segment, should benefit through an increase in income and better looking employment. On the other hand, a lower end consumer discretionary that includes food, healthcare, clothing, footwear, and household services, which should benefit from easier credit. I mean, when the lower household will be able to get credit availability increases, will help them as well. Two recommendation on how you can actually get exposure in U.S. consumer discretionary side. Unit trust, we got Fidelity Global Consumer Industries. This unit trust has, I think, 45% of its investment in consumer discretionary, and it is the closest one that we have on our platform that invests in consumer discretionary. On the other hand, ETF, we got a number of ETF available, and we chose two of them, which are quite decent and have a good volume as well. The ETF I chose was Spider S&P Consumer Discretionary and Vanguard Consumer Discretionary, that both tracks the S&P Consumer Discretionary Index. Okay, with that, I'll pass this on to Shane.
Hi everyone. Last week we had a report that came out on ASEAN consumer spending. So the objective of the report was to identify what are the spending habits of ASEAN consumers, and then identify companies that are able to take advantage of where this money is going. So we started off with Singapore, and in Singapore, food takes up about 20%, 21% of Singaporeans' monthly spending, of which grocery and non-alcoholic beverages, if you see the chart on the top right, it actually made up 42%, the dark blue box, in 2002, but by the time in 2013, it actually fell to 36%. So this means that people are heading out more often to eat. So the key beneficiaries have been restaurants, cafes, and pubs. So this is what you see in the gray bar. That has increased from 13% to about 22% over the years. And companies that are exposed to this sector are such as BreadTalk, so they run Din Tai Fung in Singapore, as well as Japan Foods that operates Artisan Ramen. So across the causeway in Malaysia, the key thing that we found was the GST being implemented about 2 weeks ago. So this was first announced in October 2013, and as you can see from the chart, the consumer sentiment has been below 100 since 4Q13, and spending over the time of about 6 years has grown at less than half the pace of income growth. So we think that this may actually result in headwinds faced by retail players such as Parkson Retail Asia. Moving forward, we have Indonesia. Now Indonesia is interesting because they are the only country where spending grew faster than income growth. So this suggests an optimistic outlook held by the Indonesian consumers. And this, we have seen that the consumer confidence index has been above 100 since September 2010. So the key thing that we took away was that they are eating out more, they are demanding more convenience, and they are increasing their discretionary spending. So companies that are exposed to these markets includes Quartz, so the furniture operator, the furniture electronics sales operator that recently moved into Indonesia. They are looking to expand that pretty rapidly over the next few years, as well as Petra Foods that they are known for their Silver Queen chocolates. Moving along, we have Philippines. Now Philippines are saving a lot more, but food still remains the largest expenditure component. So Del Monte is definitely a direct beneficiary of this aspect, but the one interesting part about Del Monte is that they recently acquired their US Del Monte US, and Del Monte US contributes about 90% of the combined entity's revenue. However, on the bottom line side, due to the acquisition cost, only the Asia part, Del Monte Pacific, is actually making money at the moment. So we'll be looking at their next quarterly and to see what's their guidance for the next year. Lastly, we have Thailand. So Thailand, the citizens are saving more. However, is this really a good thing? Because their debt has risen up to about 6.5% of its annual income, and this is up from 5.6 in year 2000. So this may be a concern for consumers because it means that the consumers are relying on debt to finance their spending, and if credit is tightened, we can see a drawdown in terms of the spending that they have in the market. So where they are spending is that they are spending more on F&B. In 2007, it was 31% of their total spending. In 2013, it was 33%. And if you see the chart at the bottom, the prepared food, which is the gray as well as the light blue one, the combined amount has actually increased over the years, with the exception of 2011 because that was the flood that they faced. So they took more food back at home. That's why you see a big spike in the dark blue that came back down in next year. 2 years later. And they're getting outside of their homes, whether is it they're eating out or they're buying food and bringing it home. So a company that's exposed to the Thai market is Thai Beverage. So to sum up, we see that the ASEAN consumers are eating out more often, and it's likely that the companies that are providing restaurants or takeaway food or convenience, these are companies that are going to be able to ride the trend of the expenditure of ASEAN consumers. So moving on, I'll pass on to Linson to talk about Thailand.
Morning, everyone. So I'll just give a brief update on the Thailand's macro. Last week we had a piece on reformers or pretenders, as mentioned by Chris earlier. So let's look at a snapshot of the Thai economy. So on the top left chart, you will see that the external trade of Thailand, indicated by the blue line as well as the red line, is still sluggish, and as well as the domestic demand yet to pick up. The exports here are actually helped by the tourist arrivals. You can see that there's a tentative sign of tourists getting back into Thailand after the military coup in May last year. But I'm sure that everyone is quite well aware of the Thai bombing last Friday in one of the famous shopping mall in Koh Samui. So that might weigh on investor sentiment in near term. And as you can see from the bottom charts, investment is yet to pick up, and also the Thais are actually quite heavily indebted. There's a huge jump in their household debt compared in the last 2 years, and that actually weighed on the personal consumption, as you can see here. Sorry. So we are expecting a sluggish economic recovery in Thailand, as well as we think that the reforms are still in their rhetorical stage, where although that in beginning of April they have lifted the martial law and replaced it with an order under Article 44. But that basically changed nothing, as the junta still have full complete authority, and they also drafted on a new constitution which actually allows that allows the military government to choose or to have an prime minister without going through election, as well as the members of the upper parliament house without going through elections as well. So that basically is what the junta is trying to do, is trying to consolidate his power. And also we are expecting the elections, we will be expecting the elections in early of 2016 instead of October 2015, as what they have promised last year. So that's a long way back to democracy for Thailand. And looking into the benchmark index for Thailand, we can see that the Thai benchmark index is quite overvalued, in the sense that PE and the PB ratios are currently both above their 10 years average. And as you can see that from here, the earnings growth is slacking, still going downwards ever since the 2011 flood. And political uncertainty will remain as the biggest risk for Thailand. And without a stable and conducive business environment, we'll be expecting that earnings will continue to slack through the first half of this year, and hence bring down forward PE towards 15 times instead of the current about 20 times. That will be about 20% of downside for the Thai equities. So I would suggest investors probably to look into other markets, for example China or Hong Kong, or even like just now what Sam have presented, US consumers, rather than overweighing on Thailand. And that's all from us today. So if there's any questions.
Hi, good morning. This is Yongkai here. Okay, I'm the US equities analyst. There's this question asking about whether there's any US consumer stocks you can recommend looking at. Okay, so right now we actually have coverage on this company, Iconics Brand Group. So we're looking at a 25% upside from today's share price of $34.68. Iconic Spring Group is quite a special company. All it does is license its portfolio of 33 brands. So all in is actually all the brands clocked about $13 billion worth of global annual retail sales last year. So it actually ranks as the number 2 global licensor after Disney, because all it does is to license out brands, collect royalties. So it has no operational nor inventory risk. Okay, margins are very high as well. You're looking at about 100% gross margins, 100% gross, 60+% EBITDA, and 30+% net. Free cash flow is very strong as well, and today is trading about 12 times free cash flow. So for more background, you can actually refer to our reports, initiation, as well as follow-up updates so far. Again, the company is Iconic Spring Group, listed on US. Thanks.
Hi, Benjamin speaking. I have a question here on Samin Technologies price drop as well as the profit guidance. Right, so yes, Samin share price has tanked quite a lot, quite substantially today, actually about 25%. Right, then they issued a profit warning last night. Right, but the thing is, the expectation over the results was already sort of announced over the last 1 to 2 quarters, and we have also shared our concerns over the 1Q and 2Q results being soft, right? Considering the downside situation that we have seen across the diamond industry. So the situation has not turned around since March, right? Over the various diamond site holdings that were being held across various countries. Alright, so the situation still doesn't look good for at this point of time, and not just for Sarin itself, but there are many diamond players out there in the Indian market, in the Hong Kong market. They are waiting for a turnaround situation to come forward. So the thing is, currently, so most of the Indian manufacturers themselves are not willing to take in the high pricing that De Beers has set in, which has resulted in the poor expected results coming up. Right, so once the rough diamond pricing has been will be readjusted going forward, right? Because I mean, for the diamond miners themselves, they are not able to sell off the rough diamonds, so they have to adjust the price going forward. It's just a matter of when and by how much. So for us, as well as the various diamond players, we are continuing to monitor the situation, right? And for the poor results wise, it's likely to continue into the second quarter, right? So we'll see. We'll keep you guys updated once we have a conference call with the management. Thanks.
Okay, this is Chris. I've got want to answer 2 questions. One is a question regarding Noble. And the question is, given the spate of unfavorable reports on Noble, is it a good time to invest? If so, at what price? Okay, one caveat is that we do not cover Noble, so we can't directly say, hey, buy the stock. But it's to help you out as far as make your own decision whether to buy it. Look, Noble is, as far as being cyclical, is one of the most cyclical stocks. And as far as the fundamentals behind Noble, everything is pretty much going against Noble right now. It is the absolute worst time for Noble as far as where it is in the hard side of its business. It's already got rid of a good part of its softs business. So things are very much going against it. But from a cyclical perspective, it is something that you do want to look at. Is Noble the worst behind Noble on a fundamental basis? I don't think so. Has more downside to it as far as the cycle goes. But as far as the sentiment behind it, it is probably maximum negative, which is pretty much one of the big things you want to look for in order to get exceptional pricing in order to decide whether or not you want to buy a cyclical, because cyclicals can essentially double quite easily. Now there's a second question as far as asking where are we in the point of the commodity supercycle. Right now, if you were to try and graph it on a sine wave, to peak to trough, we are not at the trough of the commodity supercycle. And if you look at the commodity supercycle, it's it's going to be made up of a lot of different commodities that are in it. So there are some commodities that are closer to the bottom. So if it's, as far as talking about specifics, we're looking at oil, maybe palm oil being closer to the bottom, whereas other commodities like coal, copper, nickel, zinc, aluminum, those we're looking more towards being, you know, the middle bottom of their cycle. So there's still some ways for that way to go downwards. And really, it's in order to answer that question, you really have to say, well, when is China going to be done with its financial reforms? Why financial reforms when it has to do with industrials? Well, with China, it's a lot of the monetary policy, which is their official monetary policy is to try and support investment into houses and in factories and so forth. But they're really clamping down on the unofficial side. So that is the shadow banking and the corruption side of it. So net-net, that economy is decelerating, and it's showing no signs of decelerating as that side of that policy the brakes are being applied. So you really have to answer, when do I believe China will turn that policy around in order to start buying in some of these commodities? We think it's a little bit too soon, so as far as commodity cycle, too early.
Hi, there's a question on the ASEAN consumer spending. So the question is, could you shed more light on the cost factors in Singapore, for Singapore in particular? Now, we did cover all this during the report, but I'll just highlight Singapore since the other question was posed there. From 2002 to about 2013, so that's about 10 years, housing has actually increased, over that time. But this actually includes the imputed rental. So this means that if for most owners, most Singaporeans, they own a house, but the rental, but if they were not to own the house, they were to rent it in the market, what would the rental actually be cost? So this increased from about 24 to 30%. So housing makes up the largest component of Singapore monthly expenditure. Food is second at about 21%. This has been stable over the last 10 years. Transport actually came down, and recreation has came down. Now, the transport came down from about 16 to 14. Recreation came down from 12 to 7%. The three things that has actually increased are education, health, and communication. So, in terms of other subsegments that you could be looking at for a rising dollar expenditure, it will be those three, which is education, health, and communication on top of the food. Yep.
Hi, Benjamin speaking here. I have a question of what kind of macro data has a strong, I assume, relative comparison or drivers towards the Singapore banking counter. Right, so for Singapore banking stocks, we know that for the banks in Singapore, they are mainly a strong reflection of the various economies that they are penetrated into if we look into their loan books and the exposures that they have. So it's not just for the Singapore macro data, but sometimes across the board, depending on, let's say, Malaysia, Indonesia, China, right, as well as Singapore, what kind of data are we looking at? But normally the correlation is not so direct. So what happens is it depends on how the economic growth is going. And from there, let's say on the Singapore side, let's say if economic growth is slowing down, which is really what we are seeing, right, that flows down into the across Singapore, what the system's loans looking like. So as you can see, as we have observed for the last few months, the total loan growth in Singapore, that means not just including the three banks, but also other banks as well, right, across the system. Right, it has slowed down to 1% to below 1%, depending on which segment, month on month wise. So usually these are the key drivers that we look at in terms of the macro data, not just on, let's say, export numbers or inflation figures or employment data. Right, so there's a myriad of figures that we look at, but not particularly anything that we pinpoint on for the banking sector. All right, but it's just we look at various drivers and then we piece it together to see what's the general direction going forward.
Hello, there's a question that asks which way is Singapore property market going? Any justification for the recent optimism on the Singapore property stocks? Well, we believe that for right now, although the news of the Singapore residential weakening is not something new, and we believe that the price for the weakness of the residential market has already been factored in. However, with the recent privatization of the capital, it kind of re-trigger the possible privatization on other stocks, and this has actually kind of re-rate the whole property sector on the whole. And from what we see and we believe that this could be the justification for the recent optimism for the Singapore property stocks. Thanks.
Okay, someone query about how will China and Hong Kong markets perform going forward. As we know that for the past few weeks, China has been announcing quite a few of stimulus measures, and also including that they have allowed the China fund managers to buy into the Hong Kong securities. That will help to support the Hang Seng Index, and also they have actually eased their property market restrictions that should be able to support China's growth. And we are also expecting there will be subsequent stimulus measures to help to support the slowdown of China's economy. And in that sense, we are still optimistic on the China and Hong Kong stock market. And the reason being that we saw a rally in Hong Kong stock exchange last week, being that after the news being announced in China, all the good news announced in China for the last week, and Hong Kong being in a public holiday since they are Good Friday, and also the Qingming in Tuesday and Wednesday as well. So when the market reopened in Wednesday, it actually rallied to catch up to its China counterparts. And also, currently the AH share premium, the Hong Kong share is actually trading in discount to its A-shares counterpart. So we are strongly positive on the Hong Kong market at the moment. Yeah. So there's another question. Given the improvement in Thailand tourism numbers, is airports of Thailand worth looking at? Actually, recently there's been quite a few news regarding the Thailand airlines that in a sense that they are trying to fight for more flights for the Thailand airlines, but I think there has been some negative news in regards to the number of flights that they can add on. So probably you might want to look into the F&B sectors, like what Shane has previously covered. And there's another question on what is the Thai benchmark that we used to compare on the 10-year PE or PB. So actually we are using the stock exchange of Thailand index. Yeah, I believe I've answered. I've earlier answered the question on Hang Seng, whether Hang Seng is the rally on Hang Seng is sustainable or is it in bubble territory. We are still optimistic on the Hang Seng, and we think that it will continue to it will continue its upward trajectory in near term, boosted by the reforms and the measures, as well as the liberalization in China.
Hi, Benjamin speaking here. The question on oil. What's our house view on the likelihood of WTI falling back to $40+ levels? Right, considering the expected supply of Iranian oil and continued rising crude inventory. Right, so we about 3.5 weeks ago, we issued a report giving our take on our projections on WTI prices. At that point of time, WTI price was trading about $51, $52. Right, so we at the point of time, looking at the data that we had, right, we projected a $45 WTI price within a month. So I think after about 1.5 to 2 weeks, WTI actually fell to about $47, but has since rebounded back to current level of about $51, $52. Right, so we look at the situation in US, right, which is the main driving factor for WTI prices. Right, there was a concern of there was evidently oversupply, right, looking at the production volumes that we are having coming online, as well as the inventory build up, right, across the various storage points. Okay, so at the point of time, given the run rate, right, of the build up, right, there were concerns about whether storage capacity over at Cushing, which is the pricing point for WTI, if the maximum capacity might be breached. Right, so for us, we were also concerned at the point of time how the run rate might be, but we gave some caveats in terms of how fast the refinery production output as well as the utilization might come back online. So if you look at the more recent numbers, we see that the crude inventory build up is still going strong. However, there are already early signs that the refinery utilization has come back higher. So it was about 80-something%. Now the last numbers that reported, it was at 91%. So we are really seeing basically the demand for crude oil coming back in US, right, as we gradually approach the driving season, which is a natural seasonality for, right, taking off the inventory stockpile that we see in the US on a yearly basis. Right, so since that is coming back online, we expect going forward the crude oil pile, right, over in US to gradually start coming down as the inventory is drawn down, right, to produce more petroleum products that we see over in US. Right, so that will help to relieve some of the oversupply pressures that we are seeing over there in the US. Alright, so for the Iranian side, it's affecting more of the Brent crude pricing. Alright, so the thing is, sanctions are very complex over the Iranian situation, okay, not just by US but also by various countries. Right, so for that portion wise, we see that developments are still not going on in line with what the Iranian guys want. All right, for the releasing the sanctions of the export of oil from the Iranian side. But for them, yes, the truth is they have been storing a lot of oil offshore into various tankers, right? But for them to now they're producing about 2+ to 2.8 million barrels a day, right? But for them to come back to pre-sanction levels of 3+ million per day, right? It's a lot of time, probably looking at 9 to 12 months, right? Once sanctions are lifted, before they can get all the rigs back online to start pumping out oil at pre-sanction levels. So currently it's more of a knee-jerk reactions that we see every time some form of announcement is made over the Iranian news. Right, so for us, we believe that at least for WTI wise, the downward pressure, right, has been sort of relieved, right, as numbers are coming back off for the US crude oil stockpile side. Right, so gradually as we enter into May, okay, again towards the driving season, naturally a lot of inventory will be taken off, right? So that will produce that will allow, right, a lot of pricing pressure to be released off the WTI, right? So it's likely to trade sideways or more towards $50+ levels, at least with the current numbers that we have that are being reported by EIA in US. All right, so thanks. I hope that helps for the outlook on the oil prices currently.
Hi, good morning. This is Richard speaking. There's a question on 800 Super. Is it still a buy? Yes. So far, currently our opinion for 800 Super doesn't change. It's a resilient business model and high ROE of about 20%. The company has got a good track record of winning contracts. If you go to the SGX website and look at the company announcements, they actually had a contract win about a month or two ago from Ministry of Home Affairs, and about their industry structure. I just want to remind you all that it operates in an oligopoly. So there are only 4 players for the refuse collection, and so this means that the intensity of competition is lower. And also the business model has high barriers to entry because they need to win the contract from NEA, and these contracts last for typically about 7 years. So that's for the refuse collection, and then there's also the street cleaning contracts which last for several years as well. So these contracts will sort of give them a stable revenue visibility, and it also prevents new entrants from coming in. Thanks.
Hi, good morning, Teo Hong here. There's a question on REITs, and the question is about, given that fixed income is going out of favor and interest rates are increasing, should we start to exit REITs? And another question is about REITs generally, are they overpriced? So we have seen a strong run for REITs in the recent 2 weeks, and I think these are because these are on the back of expectations of a delayed rate hike over in the US side. So we see, like, we expect REITs to continue to be volatile because week in, week out, or month in, month out, you get a good jobs report, and people expect rates hike to be sooner. Then this kind, the sentiment towards fixed income and REITs will start to vary with this kind of expectations of the timing of the rate hike. So we expect REITs to be still volatile, but post the strong run over the past few weeks, we are sector selective as to which kind of REITs are still a buy for us. We are bullish on certain retail REITs. We have coverage on FCT, and target price is 214. So current price at 205, we think there's still a bit of upside for that. Capital Retail China Trust, it has kind of reached our target price, so we will be kind of very wary for that, for any kind of further appreciation from now. And for the commercial side, we would be pretty wary as well because of the huge supply coming up in commercial properties next year. So we saw, like, 2 weeks ago or last week, we saw this headline news about Apple grabbing 2 floors of office space in Capital Green, which is under Capital Commercial Trust. So the rental rate for that kind of contract is about 11 to 12 bucks. While we wouldn't say that it's on the high side, we would think that this kind of news reinforces our viewpoint that now the drivers for office space in Singapore are mostly on the tech sector. So the biggest occupiers of the commercial space currently, the financial side, is not expanding as fast and as quickly as we would like.
So given the huge supply coming up next year and slowing down of the financial sector, we would be wary of the commercial space for REITs. As for industrials, we will be bullish on business parks. So we have this report which came out last week on soy build, which is basically reiterating this Channel News Asia article stating that business parks occupancy rates have gone up in the first quarter. So we are bullish on soy build for that. And on the industrial space, we are also bullish on cash logistics because we think that cash will be able to ride on the Singapore's position as a logistics hub, as well as the fact that cash has properties which have newer facilities as well.
Hello, that's a question that's asked. Any more upside expected from Silimaland? Our target price is 0.96, though the share has actually rise quite a bit year to date. We are still positive on the stock, and we still see that there is possible upside on Silimaland going forward. Thanks. Hello, that's all we have for today. Thanks for tuning in. See you guys next week. Bye.